My experience in the last 25 years, 26 years now, has been instructive. Gold has generated almost a 9% internal rate of return annually in my portfolio, which is to say it has kept pace with pricing levels. When I, as I do, informally look at my income expressed in gold, my assets expressed in gold, and my costs expressed in gold, I'm surprised at how cheap things are. Real estate measured in gold is cheap. Food measured in gold is pathetically cheap. Health insurance and healthcare measured in gold are cheap. When by contrast I measure them in US dollars, all of those things are frightfully expensive. That tells you gold's true role. The recent decline in the gold price tells you something else ironically positive about gold. It was a source of liquidity.
When inflation surprises to the upside, interest in gold typically follows. And, with inflation now back above 3% and energy costs driving uncertainty, that historical relationship is once again in focus. Veteran analyst and founder of Rule investment media Rickrule explains that over many years, gold has acted as a reliable store of value, maintaining purchasing power. Seasoned expert also highlights gold's exceptional liquidity, noting that it can be quickly converted into cash or used as collateral at any time, making it especially valuable during periods of financial stress. Using examples like Turkey, he emphasizes that selling gold during crises is not a weakness, but a demonstration of its reliability as a financial safety net. Global demand for gold remains strong, with central banks expected to purchase around 850 tons in 2026, continuing a multi-year trend of accumulation driven by concerns over currency stability and geopolitical risks. Regarding portfolio strategy, Rickrule notes that short-term price declines do not concern long-term holders and are instead viewed as opportunities to accumulate more. He further adds that he sees silver as a more speculative asset, preferring to buy it only when market sentiment turns negative. While he acknowledges that silver could outperform gold over time, Rick remains focused on gold in the current environment, citing ongoing economic uncertainty as a key factor supporting its strength. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rickrule's recent interview.
My experience in the last 25 years, 26 years now, has been instructive. Gold has generated almost a 9% internal rate of return annually in my portfolio, which is to say it has kept pace with pricing levels. When I, as I do, informally look at my income expressed in gold, my assets expressed in gold, and my costs expressed in gold, I'm surprised at how cheap things are. Real estate measured in gold is cheap. Food measured in gold is pathetically cheap. Health insurance and healthcare measured in gold are cheap. When by contrast I measure them in US dollars, all of those things are frightfully expensive. That tells you gold's true role. The recent decline in the gold price tells you something else ironically positive about gold. It was a source of liquidity in times of need. The Turks in particular needed to sell, believed they needed to sell their gold to defend their currency, to keep politically expedient domestic pricing low. And they were able to do that. Had the Turks gone to the global bond market and tried to borrow any currency in the world, but particularly Turkish lira, they would have been singularly unsuccessful, given the fact that they had 60 tons of gold to sell and sold it. They weathered the storm. And there's a real lesson there. Gold has spectacular liquidity, 24/7. In any markets. You may know, you can see my logo. I'm the founding shareholder of a bank, Battle Bank. And one of our premise is that we love to lend against gold as a piece of collateral. We love to lend against that collateral because we can perfect and sell that collateral if somebody didn't pay us back anytime, 24/7, in any quantity. It's really unique in that regard. It would seem to be a substance that maintains, in a real sense, its purchasing power. And it's also uniform and insanely liquid. It's volatile in price in the near term. But if you look at any other asset that you have in your portfolio, they're volatile too. If you look at currencies, various different currencies, and you measure them against a basket or against each other, they're volatile. If you want to see real volatility, look at your home. Have your home appraised by 3 different appraisers, and you will find at the same minute of the same day that the price of your home, according to a non-market transaction, which is to say an expert, varies by as much as 10% per second, uh, depending on the valuer. So I think this is going to sound trite. I think including gold in one's savings portfolio is simply a matter of sanity. I don't think that there's an excuse for not holding it. Whether or not gold is an investment class or a speculative class depends more on the investor. But as a savings class, a savings or insurance class, I think not holding gold is irresponsible. I own a lot of gold, and a financial planner would look at me as the largest shareholder in Sprott, in effect, a financial services brand name for gold, and that planner would say, Rick, you are crazy owning gold. You don't need any gold. But I'm an old man. Gold allows me to sleep nights and stay calm. My gold isn't for sale at this price, so I would like to see it cheaper. Where people who are speculators and investors are afraid the gold price might fall, those of us who are savers are hoping the gold price falls. Given that a move in the gold price from 4,600 to 4,700 or 4,800 would not benefit me because I wouldn't sell, I would prefer to see gold fall $400 or $500, in which case I would be a buyer, as opposed to go up $400 or $500, in which case I wouldn't be a seller. So I really think it depends on your perspective. I hope, not for the benefit of citizens of these Middle East countries, but for my own benefit, I hope the gold price falls. I was a buyer in January when I sold 80% of my physical silver. I had that silver in a speculative account. In other words, the role it played for me was speculation. And when silver went from hated to loved, when there was that parabolic up move, I sold 80% of my silver. And I put 25% of the sales proceeds into savings, which is to say I put it in gold. If I generate more liquidity, I likely will continue to overweight gold relative to short-term U.S. cash, which is my other savings vehicle. I believe the next 10 years will unfortunately be good for the gold price. I say unfortunately because circumstances that are good for the gold price are usually bad for credit markets, and credit markets are where people live. And I suspect that over the course of 10 years that silver will outpace gold. I have always regarded for my own portfolio, and this is always personal, silver to be a speculative asset. And there are other asset classes within speculation that I prefer to silver. So for me personally, unless we return to a situation which we saw 4.5 years ago, when I was first interviewing with Palisades Gold, where silver was hated, I wouldn't be a buyer. I remember 4.5 years ago, after the aborted silver squeeze, silver below $20 an ounce, and I remember looking at the internet discussion groups where 9 out of 10 commenters on gold were hugely negative. Hugely negative. I love circumstances like that. I love circumstances where a commodity for which there's ongoing demand experiences rank hatred. There's nothing in the world I like as a speculator more than hate. And so until and unless we saw that circumstance back in the silver market, which I don't anticipate we'll see for 12 or 15 years, I won't be a silver speculator. I will note that if we dial ourselves way, way back in history, probably before you were born, 1975, in the midst of that wonderful bull market, 1970 to 1980, where the silver price ran from $1.50 to $50. I mean, a truly, truly remarkable run. In the middle of that, the early part of 1975, the gold and silver prices both fell by half. And there was a 5 or 6 month period where in the midst of that just spectacular bull market, that silver returned to being hated again. So I wouldn't rule out a situation where, as a response to higher interest rates probably in the U.S., if that occurred, that both the gold and the silver price would be derailed temporarily and would experience real hate. Certainly in 1975, there was widespread hate of gold and silver, particularly among the people who were new adherents to it in 1974 and got high-sided. And if that occurred, I might return silver to my portfolio in a speculative place.
During the interview, Rickrule states that the next decade is likely to be strong for gold, although he views that as a warning sign since conditions that benefit gold often reflect stress in credit markets and the broader economy. While gold will perform well, silver could eventually outperform it over time. However, he continues to treat silver as a speculative asset, only showing interest when sentiment becomes extremely negative. Drawing on historical examples like the mid-1970s, he notes that even during strong bull markets, sharp corrections and negative sentiment can appear temporarily. Current opportunities may lie more in overlooked regions or undervalued sectors, including certain energy and mining investments, while expecting increased consolidation and takeover activity within the mining industry as larger companies acquire smaller, undervalued firms. U.S.-listed shares of gold mining companies rose on Friday as gold prices extended gains after Iran announced the Strait of Hormuz would remain open to commercial shipping during the Lebanon ceasefire. Let's jump into the interview.
When I sold my silver, noted that the silver miners were priced on Wall Street and Bay Street using an approximate $45 per ounce price of silver, which is $75 seemed too cheap. So half of the money that I raised selling my silver, I put into the silver miners. The arithmetic to me was if the silver price kept going up, that the miners would go up with the silver price. If the silver price went sideways, by definition, I'd make no money on the silver, but the silver miners were priced at $45, so I could still make substantial profits in the silver miners. And paradoxically, if the silver price fell, that there was some shelter in the silver price as a consequence of the fact that the equity prices were discounting $45 silver in a $75 world. That circumstance exists today. In the gold markets, I'm of two minds. My instinct tells me that over 10 years, the beta in the gold market, I would define beta as the difference between the performance of gold equities relative to other equities, will be significant and substantial. And part of me says at my age, when I ought to be retired, that I should confine my activities to the biggest and best companies, the Francos, the Wheatons, the Agnico Eagles, because I think they're going to do spectacularly well with relatively little company risk. But the valuations of those companies relative to the best of the best in the other sectors are high. And an investor like me who is patient and disciplined and educated should be coming down the quality trail. If he is a he, pardon me, I was a Californian there for a minute. If he is a he, should be looking as an example at single asset producers, which are viewed rightly by the market as more risky than multi-asset producers, but the discount goes away if they get taken over. I mean, immediately. The whole circumstance that we're seeing in the gold equities chain is that the larger producers have more liquidity, more trading volume, and higher share prices, and the rest don't. If value arbitrageurs don't come tighten the spreads between the big companies and the small companies, the market will. The big companies will take over the small companies. I think we're going to have an M&A streak in mining. Witness the recent G-Min takeover of G2 at a 72% premium, yet still accretive. That'll tell you how much room there is in the next 3 years in the gold mining space. In terms of expressing that, mercifully for me, I expressed it 4 years ago, 5 years ago. And if you looked at my own portfolio in an allocation sense, you would see a gross over allocation to gold. So I don't need to go deeper into the space. I will start by saying that if you merge every junior gold explorer in the world into one company, Junior Explorco, that company would lose about $2 billion a year. So what should you pay for that company? 10 times losses, 12 times losses? In a bull market, maybe 15 times losses? The point is that the junior mining industry is always overcapitalized because as an industry as a whole, it's worth nothing. It's worth less than nothing. It destroys capital. That belies the fact that the best 10% of juniors generate so much value that they add legitimacy and even luster to a sector that loses between $2 and $5 billion a year. So it's a stock picker's game. The overall junior market is hopelessly overcapitalized. I mean, hopelessly overcapitalized. It's probably 1,500 companies worldwide, and there's probably 200 that are viable. Now, that doesn't mean that in an increasing gold price, that the Vancouver used car salesman won't be able to, tweet stuff out about Amalgamated Moose Pasture and how the gold price is going to go up. And it doesn't mean that those shares won't do well. But in terms of the juxtaposition between price and value, the only way that you can afford to speculate in that game is by really learning a lot about the underlying value of the assets, doing the work. You may know that I've graded now over 35 years almost 100,000 portfolios, and I've learned an awful lot about the mistake that individual speculators make. Much too narrative oriented, much too lazy, own way more stocks than they can follow, much too impatient, not tenacious enough. Making money in junior explorers, which is one of the sort of roots of my own portfolio, involves doing a lot of work. It involves holding for 5 or 6 year time frames during which the individual equities can fall 50% in price or more without derailing the value story. Most speculators aren't willing to do that. And the consequence of that is that most speculators, if they did an honest self-assessment, wouldn't, or at least shouldn't, speculate in the junior sector. For those of us who do, it could be a truly, truly, truly wonderful place, as my own portfolio testifies.
The U.S. economy has experienced significant changes in recent years, with prolonged inflation taking a toll. Gold can act as an inflation hedge within a portfolio. Currently, gold remains a stable asset amid high market volatility. Prices have reached record levels, climbing over 25% since early 2025, driven by persistent inflation and economic uncertainty. Many experts recommend adding gold to diversify holdings. Financial analysts with J.P. Morgan and Morningstar project continued strength in the gold market. If the global conflicts remain unresolved and central banks maintain their current rates, gold will continue to act as a safe haven asset for both institutional and retail investors. Because of these factors, experts with J.P. Morgan and Morningstar believe that gold will perform well this year, with sustained higher prices in 2026. If gold continues to prove its role as both a safe haven and a liquidity source during crises, could the next decade redefine how investors prioritize gold within their portfolios compared to traditional assets? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.